Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, I want to get to a name that is certainly on our radar. Shares of Zillow down the most in nearly 1 year. The stock off more than 9%, was down 17% at its low today. The online real estate firm delivered a revenue forecast for the first quarter that fell short of the average analyst estimate. Meantime, the company expects 2025 to be its first profitable year since 2012. Keep in mind, it posted a net loss of $112 million back in 2024.
With more on the business and the U.S. housing market, with us is Zillow CEO Jeremy Wacksman, joining us from Seattle. Jeremy, thanks for joining us today. Likely, I would imagine, a tough day when the stock is down as much as 17%, down 9% right now. The housing market, it just hasn't recovered in the way that you want to see. What's the biggest thing holding it up?
Thanks for having me. The housing market remains challenged. It was challenged in 2024, and we're expecting it to be so again in 2025. Zillow reported great results yesterday. Q4 revenue up 17%, and we hit our goals of growing revenue double digits last year and expanding our margins. And we also guided yesterday that we expect to continue to do that again this year, with revenue growth in the low to mid-teens, more margin expansion, and positive GAAP net income for the first time in a long time. And as you said, that's against a persistently challenged housing market. So we're able to grow and gain share both in 24, and we plan to do that again in 2025, while the market remains depressed for volume and challenging for buyers.
Jeremy, do you think investors have it wrong in terms of pushing your share price down a lot in reaction to what they got on the quarter and the outlook?
We don't really focus on the day-to-day voting machine of the stock market. If you zoom out and look over the long couple quarters or couple years, we've made great progress on our integrated super app strategy. We're growing revenue nicely. We're outgrowing the category, and we can plan to continue to do that in 2025. And so over time, the stock takes care of itself. The company grows in value as we really deliver on our promise of helping more buyers and sellers get home. That's really our goal at Zillow, is to help more of our audience turn into transactions.
Yeah, and I will point out the stock was up about 28% last year and up about almost 80% in 2023. In terms of the stress, though, or maybe your, kind of cautious outlook in terms of the housing market, is it all about mortgage rates and higher mortgage rates?
Yeah, the challenge of the housing market starts with mortgage rates, but it's really about availability and supply. We are expecting flat-ish total dollar value housing market in Q1 and low to mid-single digit growth for the year. And as you said, if you look, it's not like 2024 was that much better from a volume standpoint. The real challenge is with mortgage rates staying high, affordability is a challenge for buyers, but that really locks a lot of sellers into their homes as well, right? A seller is thinking about, do they want to trade out of that mortgage? Do they feel locked into that mortgage? And many are foregoing listing their home and making that move. So you're seeing still very low inventory. Inventory is up 18% from last year, but it's still down sharply from pre-pandemic norms. And so lack of supply really makes it challenging for buyers. And then you add elevated rates and what they can afford of what there is to buy.
Jeremy, the cost of housing, certainly a theme on last year's presidential race. I'm wondering if you think that the federal government will be able to achieve bringing more supply of housing online. This came up at the vice presidential debate when J.D. Vance talked about using federal lands to build homes. Do you think the federal government will have a meaningful effect on housing supply?
The real challenge with supply, we talked about existing home inventory and what sellers are doing, but we are chronically underbuilt, right? Zillow estimates about 4.5 million homes have not been built to keep up with the demand needed since the global financial crisis. And the solution to those problems really is at the state and local level. You need things like permitting reform and removing red tape in the process to get starts done quickly. You need tax incentives and financing options so that builders can get their projects online more quickly. So the totality of the problem, nearly 5 million homes that we need to catch up on. We're not going to do that overnight, but slow and steady will definitely bring more supply to the market.
I do wonder, though, too, Jeremy, how much, though, yep, I get that, the permitting. I mean, these are problems that have plagued certainly the housing market, I feel like forever in terms of supply. But having said that, how much too is there some cautiousness on the part of home builders who everybody still remembers 2008 and the overbuild? So is there also a part of that as some of the components in terms of supply?
Well, you're seeing places where it works well, right? I mean, Austin, Texas is one good example that we've highlighted where a lot of multifamily inventory in the rental market has come online, and you've actually seen rent prices come down, even with the population growth in Austin. And so, you have to remember, if you zoom out, there are still the counter forces of for sale and rentals working together. And, when folks can't get it done and find the home to buy, they end up re-renting, and you're seeing, rental inventory grow to satisfy that demand as well. So it is, as you said, it's a local issue, but there are places where it's working well, and there are places where it can work even better.
We got a hotter than expected CPI print earlier today, and my question is about how that changes the outlook for rates for the year, and then in turn how that affects your business. Does your outlook for 2025 change if rates don't come down?
No, our outlook that we put out yesterday assumes a pretty lousy housing market. And I think today's print probably just kind of confirms that fact, right? We are expecting flattish housing market in Q1 and low to mid single digits for the year. And I think we were maybe a little bit more bearish than most heading into the year on how the housing market's going to do. Now, the good news for Zillow is we're outgrowing the category and we're gaining share. We did that in 2024 and we expect to do that again in 2025. And that's in our for sale business where we're helping more buyers meet their agents. We're helping originate more mortgages. That's also in our rentals business. Our rentals business grew 25% in Q4, and we expect that to accelerate in Q1 as we bring more rental inventory to more renters across Zillow.
Hey, one thing I do wonder in our conversation coming off of the hot CPI print, Jeremy, is that maybe we saw certainly the rates market, the U.S. rates market, the Treasury market react and move up today. But now the talk has moved to maybe even the next move. We need to start thinking about the Fed raising rates. If we see the Fed start to raise rates, what does that do, in your view, to the housing market, and how might that impact your business?
Well, as I said, we're kind of near all-time lows on volume, right? We're down to basically folks who have to move and can get it done. And that's the thing about this market. Long-term, real estate is a growth industry. You see volumes and total value grow. Right now, you're seeing depressed volumes because of all the challenges, especially in the financial market with affordability for buyers. But folks are getting it done, and they will get it done. And what we're here at Zillow to do is help them, right? Buyers who need to buy, many of them are starting that conversation with financing rather than just dreaming, right? We now see about as many buyers start with what can I afford and can I even buy right now as they do dreaming, shopping, and going meeting an agent. And so we've brought online tools like Buyability to help them truly understand their personalized payment information. What can they actually afford for themselves given their financial information, so they can have confidence to go get a pre-approval letter to actually go make an offer and win a house. So it is tough out there. It will remain challenging in 2025, but folks can get it done. We're there to help. And that's exactly what's driving the results you saw from us in Q4 and why we expect to continue to grow and outgrow the category in 2025.
Jeremy, you mentioned those buyability tools that you guys have on your platform. What does that show you about? Is it the first-time home buyer that continues to find it really difficult? Is it the trade-up home buyer? What does it tell you about kind of the home buyer and, in essence, the U.S. consumer out there when it comes to buying a house?
Yeah, I mean, the demand and desire to buy a home still persists and exists across all demographics. You're seeing folks having to wait longer, save up more to make that down payment. And so it gets tougher, but you see the strong desire to buy a home really persist across all demographics. And we see that in folks who are using Zillow. Again, as I said, one of the things that is interesting to us is how much more financing and total cost of ownership is front and center for a buyer before they even start. 5-10 years ago, everyone wanted to start by shopping, by touring, by virtual touring, by going into open houses. And now it's kind of a balance. As many folks want to start in that state as they want to start with just the reality of what's my budget look like? How do I set my budget and work with an agent to make sure the homes I fall in love with are the ones I can actually buy?
Hey, one thing we also learned recently from you guys is that Redfin is teaming up with Zillow for rental listings. This partnership, to me, it sort of looks like frenemies teaming up. Like you guys are competitors here. Redfin's market cap is about $2 billion. You're about $18 billion. Do you end up buying Redfin at a certain point?
We're really excited about this partnership we just announced with Redfin. it's a big step in our overall rental strategy. It's important to zoom out and remember, unlike the for sale marketplace, there's no national database for rentals. The big challenge a renter has is they can't find all the supply. They have a very short time frame to find a place to rent. And so they scour the internet, they scour offline looking. So that's Zillow's strategy. Can we organize more and more of the rental listings out there nationwide so that renters on Zillow and on our partner sites can find them? That strategy is working great. That's what's driving having the leading audience and growing audience of renters. And that's bringing more property managers to Zillow and our partner sites to want to advertise to that audience. So this partnership with Redfin to power their rentals business is just the next step in that strategy. Adding on to this great partnership we forged with Realtor.com last year, it allows advertisers to come to Zillow and get advertising in front of Zillow sites, Redfin sites, and Realtor sites to reach an even bigger set of renters. And then renters get more choice, right? They see more inventory, which again, as I started, that's the big problem in rentals is you cannot find all the inventory.
And forgive me, that Redfin market cap about $1.1 billion, so shy of $2 billion. I didn't hear a yes or a no in the answer to my question about whether or not you acquire
no plans. No plans. We're very excited about the partnership. We've worked with them on some other things before, and we love how culturally aligned they are and just digitizing the transaction in real estate.
Well, along those lines, how are real estate companies holding up through this extended housing market trough? I mean, any opportunities for you guys to do some acquisitions as a result, along maybe the lines of, I don't know, partnerships, but maybe even acquisitions?
Yeah, the bright side of a challenged real estate market is it really allows the best professionals to gain share, right? When it's rainy and cloudy outside, those that do best sometimes come out ahead. And what's great about that is that aligns so nicely with Zillow's strategy, right? Zillow's strategy is to partner with the best agents and agent teams in the industry. 80% of the agents that we partner with are in that top 20% of producers nationwide. So these are the folks that are operating businesses at scale, training great agent teams to help delight customers. So even when there's less transactions to do, and even when it's a challenging conversation with many buyers and sellers, those folks command great price, hold share, and grow their business. And so in some ways, having a choppier or a depressed housing market can advantage some of the best professionals.
Hey, we're asking every CEO we talk to these days a couple of different questions about politics, about AI. Politics is where I want to go and just hear from you about how you view this new Trump administration in terms of changes that you've made at the company as a result, or what it means for you as a business.
One of the things Zillow focuses a lot on is AI and AI as it comes to the real estate industry, right? Both for us as employees, but more so for our customers and our partners, our agents, our loan officers. And we've been investing in and innovating around AI for decades. And so now as generative AI comes to the forefront, we've been really advocating for responsible regulation around AI that encourages and supports innovation so that companies like Zillow can continue to innovate on behalf of the customer. So one thing we're very excited about is the continued progress on the ability to progress with AI. And, AI for us is a feature, it is a tool for our customers, for our employees. But in the real estate industry, it's really about making the professionals more efficient and effective, right? There's so much wasted work, busy work, paperwork, back office work. And when you talk to a great real estate agent or a great loan officer, that's not what they want to be doing. They want to be delighting customers. They want to be winning more business. They want to be getting more transactions done. So we're really excited about the ability to continue to lean in and innovate, not just on our tech platform generally, but on AI specifically to really bring more of this transaction into your smartphone, make it more delightful and faster for the customer.
All right, Jeremy, one last question, and it is also a question we are asking to heads of companies, CEOs, and the like. Anything that could come out of Washington and the new administration that could help or hurt your business? And just got about 30 seconds.
Zillow is really focused on ensuring that real estate stays accessible for the customer. We've outlined our principles for the consumer, which are around transparency, access, and affordability. And any policies that come, we look to help make sure they push forward and ensure that consumers have access to all the information that's out there, have access to great professionals, and have better education on how the real estate industry works. Real estate is one of the largest industries that there is, and it's the single biggest decision that most individuals are going to make. So making sure that people understand how it works, making sure that they have access to hiring the best professionals. That's one of the things we're very focused on at Zillow, and we will continue to be.
So you're hopeful that the administration, the policies will be supportive of the housing market, just quickly?
Yeah, we've been around for 20 years and have been fortunate to work with both administrations. And again, as we talked about earlier, one of the real challenges in our industry is so much is done at the state and the local level to make sure that real estate can flow for the benefit of the buyer and seller.
Really good point. Jeremy, thank you for all this time. Jeremy Wacksman, he's Chief Executive Officer of Zillow, joining us on this Wednesday.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, for a look more closely at how that spending freeze could affect states, we welcome Tim Sullivan, CEO of the New Jersey Economic Development Authority, also known as the NJEDA. It's a state agency responsible for economic growth and development in New Jersey. Tim joins us from New Jersey. Tim, good to have you back with us. New Jersey is a state that is part of this coalition. NorthJersey.com reporting that Governor Phil Murphy says this freeze could cost New Jersey up to $27.5 billion. Is the money flowing now?
Yeah, so the governor, I think, correctly highlighted what a big potential deal this is for Jersey and lots of other states. You know, obviously this is a subject of ongoing litigation that our Attorney General, Matt Placken, is leading, and certainly would have a huge impact. I think that's why you've seen the governor and the Attorney General standing up and saying this is this can't happen.
Yeah, I mean, you know, we want to move on to some other things, but I mean, what kind of an impact, this is some serious spending, would it mean for the state of New Jersey in terms of its economy?
Yeah, again, when you start talking about tens of billions, $20 to $30 billion, that's a huge impact. New Jersey's a big state with a $600 or so billion GDP. We're a big state, but that's a lot of money, and a lot of people rely on it, both for economic development purposes that me and my colleagues care a lot about, but throughout the state, whether that's education or human services or any number of things, it could have a huge potential impact.
Tim, are you and the team and the governor already thinking about, okay, in case this does go away, we've got to start thinking about different ways that are going to drive growth within the New Jersey economy? Full disclosure, my home economy.
Yeah, it's thinking about how we grow the economy is something we do all the time, no matter what's going on in Washington, no matter what's going on, with federal policy changes, and so. Certainly if there was a dramatic shift in federal policy on any number of funding streams, there'd have to be a course correction. And that's well above my pay grade. But, in terms of things that we're trying to do to grow the economy, we're going to continue to focus on the things that Governor Murphy's been focused on for 7+ years now, which is, growing new industries, supporting small business, supporting innovation, trying to grow, more new young companies that grow and scale and add, tens of thousands of jobs.
Can you tell us where the federal funding goes versus where state funding goes? Like, where would this money, if it were frozen, where would people in New Jersey feel that?
Well, this is a bit outside my lane, so I don't want to hesitate to comment too broadly. Obviously, the governor put out sort of a report on our federal funding either earlier this week or late last week. It's pretty broad and deep. I can tell you with regard to economic development, we have significant programs that are funded around environmental remediation. We have programs that are funded around, supported around small business. The big slug of funding that came from the American Rescue Plan supports small business funding, and so the ramifications could be really, really significant.
Hey, let's go to congestion pricing, because we haven't had a chance to catch up with you since this has been implemented.
I paid my first congestion pricing this week.
How quickly did you get into the city yesterday, Carol?
I got fairly quickly, but I don't know. It was pretty early in the morning, so typically I don't see a lot of traffic.
Well,
but I don't know.
I think we spoke to Bill Maloney yesterday, who said even early in the morning he's getting in.
Huge difference.
Yeah, huge difference.
Huge difference
Tim,
on New Jersey.
Yeah. What does it mean for New Jersey? What does it mean for you?
Yeah, so this is something the governor's been pretty clear on, and this is also subject to some ongoing litigation. So I got to be mindful of how I comment here. But the congestion pricing, the governor's not opposed to it in any form. It just doesn't think the way it's been approached here is the right way to do it, because we don't have a complete data set based on anything I've seen of whether folks have switched how they're getting into the city or what roads they're taking or whether they're rerouting, and trucks and cars have different options with regard to mode shifts. And so, whether that means pollution in, Hudson and Bergen counties, whether that means, different impacts on our traffic on our side of the river. And I don't think there's been enough data yet to reach too many conclusions. But the governor's been clear that the current framework doesn't work for Jersey, and that's where we stand on it.
Well, and I guess what we're really more interested in terms of your view, Tim, like, what do you do to say, all right, folks, you don't want to pay the congestion tax? Come on and set up shop here in New Jersey.
Yeah, exactly. We've got some ads running both on I think taxi toppers and a few billboards through the city and digital, making that exact point of, even if commutes get a little better, it's still a slog in and out of the city every day, particularly if you're driving. And why not avoid that and avoid that and come to Jersey and set up shop?
Is it working?
We've got a number of incentives programs. One of which that is being highlighted by those ads is called Rise, which basically is for folks who are remote working. If you classify them as Jersey employees, we'll give you an incentive to do so, and the state benefits from a tax perspective, state of New Jersey. And so that's one of the programs we're pushing on that front.
I know it's only been a little over a month since congestion pricing went into effect, but is that ad campaign working? Do you have any data you can point us to?
It's early days for obviously congestion pricing and for that campaign. We've seen an uptick in interest in the program that we're marketing for sure. And I think folks are, evaluating the implications of what congestion pricing means for their workforce, both, big businesses and small businesses. And the message we want to send is Jersey's open for business, and we're eager to help more businesses locate here.
Hey, one of the things I'm always curious about, Tim, and we just talked about this a lot coming off of the Super Bowl and just the building of stadiums around the nation and what that means for a local economy. And often, you tap the muni market to pay for some of this or a lot of it. Something like the Prudential Center or MetLife Stadium, like these kinds of facilities, what does it do? What kind of economic might does it give to the New Jersey economy?
They're incredibly important. I mean, sports and entertainment, broadly speaking, are incredibly important economic drivers, not just for Jersey, but all around the country.
Is it the top, one of the top drivers of economic growth?
It's certainly one of the big ones. New Jersey is blessed with lots of drivers of our economic growth, including things like the pharma industry and the booming film and television sector that's taking root in Jersey. So we've got a lot of contributors to the growth story. But when you look at things on the forward radar, things like the World Cup in 2026, Jersey will host the final, and I think 8 games. The projected economic impact from that alone is ranges from $2 to $3 billion.
You've worked,
and so that's,
yeah.
That's
Sorry, go ahead.
Extraordinary, and we've got the Club World Cup coming up as sort of a dry run for that this coming summer. And when you think about the Prudential Center and all that, not only the Devils and Seton Hall plays basketball there, but you've got some of the best concert offerings anywhere in the world come through the Rock, and that's one of the top performing concert venues anywhere in America. And so it's a huge driver for Newark, and it means it's great when there's hot concerts in town or whatever, but it means a lot for small businesses in Newark that restaurants and pubs and bars and everything else that supports activities like that.
How much of an economic driver is Bruce Springsteen?
It's hard to put a value on the boss. I'm a huge fan, so you're tempting me to sort of geek out on various things I might say about the boss. But he's critical to our economy. He's a state treasure.
All right, what about
we have Bruce Springsteen Day officially in law in September.
Of course we do. What about the Housewives of New Jersey? I'm only kidding. I'm not going to ask for the economic impact of that. Tim, so glad we got some time with you. Tim Sullivan, he's Chief Executive Officer of New Jersey Economic Development Authority, joining us from the great Garden State, my home state.
I'm a Jersey girl. Full disclosure,
I'm a Jersey girl.
You're
love
biased.
It. No, I'm not. I speak the truth. I'm a journalist. I can make, the distinction. It's incredible. This is Bloomberg.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
For a check on how consumers are faring in this economy, we bring in Scott Zoldi, Chief Analytics Officer over at FICO. It's the analytics and credit rating company. He joins us here in the Bloomberg Interactive Brokers studio. You see a lot of data. You comb through a lot of data. How are consumers doing?
So consumers, there's definitely a lot of sort of focus on, prices and inflation, right, in terms of how they are transacting with their payment cards. We primarily look at consumers with respect to fraud detection. And so as part of that, we look at what are those patterns, how are they changing in terms of whether or not they are being susceptible to fraud. And we use machine learning to do that, to make a determination of whether or not they are experiencing fraud or not fraud in these difficult times.
How often is that happening?
So essentially, with each and every transaction that occurs, there's a decision that gets made with one of these machine learning models that will make a decision between, fraud or not fraud, and it's automated. So every time you swipe your card, a decision gets made. And these are technologies that we developed more than 30 years ago, and they continue to serve well in basically that infrastructure protecting payment cards.
Where do you play in the ecosystem? For example, if I use my American Express, if I use my Chase card, are you there behind the scenes?
So we're behind the scenes for many of those banks, right? And so essentially the way it works is that we're an analytics software company. We pioneered the use of machine learning more than 30 years ago in the detection of fraud. And we operationalize AI, which is a really difficult problem today in this sort of golden age of AI, actually making it practical and usable. We build those neural network models, and then we install our software at many of the banks. And then the banks use that score, which goes from 1 to 999. The higher the score, the more likely it is fraud, in a strategy in terms of whether they block a transaction and for suspected fraud.
We've all been there, right? We get a call and they're like, hey, is this you? We want to check like a fraud alert. Hey, Scott, what I do wonder
How did you spend, $1,000 on those 2 dozen eggs that you have at home?
Listen, sometimes it's like, I'm like, honey, is this you? And I'm like, it's fraud. Hey, Scott, one thing I do wonder is in an economy, I'm wondering when things are going well, is there less fraud or more fraud? In an economy that might see consumers pulling back, is there less fraud? I'm just curious.
Yeah, I mean, fraud is essentially always there, right? I think,
but the level of it, I'm curious.
The level will generally increase, right? When we see sort of harder, more difficult times, and so there'll be more people that will take advantage of fraud, and so they may play a role in the fraud. We call that muling, where someone will transfer money in terms of a fraud event, and so definitely it makes for harder times. People will turn to crime. Now, with that said, most of the fraud is committed by sort of organized data science teams, very specialized individuals, but they're always looking for recruits, and those recruits will help facilitate that fraud, whether they'll capture details or whether they'll allow money to pass through their accounts to the eventual beneficiary who is a fraudster behind the scenes.
How are you doing with recruits? Everybody wants people who work in AI right now.
Yeah, we're doing really well, fortunately. I think FICO has a great reputation as an AI and machine learning leader, and we operationalize those models. So instead of having an academic conversation about the use of AI, it's actually deployed. And so most of our staff have been here for more than 10, some 20 years.
Well, you said that you've been doing this. This technology has been developed, for decades. Mm-hmm. How much has it changed in the last couple of years since we've seen the huge jump that ChatGPT at OpenAI was able to make? You've seen the development of Anthropic, these other LLMs, and the rise of NVIDIA as well. How much has that improved your AI models?
So, this is an area where you constantly have your adversary, the fraudsters, with their own AI models, and they're trying their own innovations to steal better. For FICO, we have more than 100 patents in AI and machine learning that we've evolved over the last 30 years. When it comes to things like transformer technology, we're constantly evaluating bringing that in to improve the technology. But the amount of energy that we spend on innovation is immense, right? Because it's basically an arms war between those data scientists on the dark side and those on the light side. Things like NVIDIA and transformers, these are opportunities to try new technology and layer it into what has already been working and working well behind the scenes.
Scott, one thing I do wonder, and with fraudsters, I've heard that they'll basically try a small charge and see if it goes through and then amp it up. But what is the typical pattern, or do they just go for a big spend? How does it work?
Carol's trying to do some crimes.
No. I mean, the one thing we went to, it was like somebody bought tickets to a Vegas show, and I'm like, I haven't been to Vegas, honey. Have you been? And he's like, no. So but I'm just curious, how do they do it so they can get it through?
So they're going to try to take a transaction that is not obvious, right? Yeah. So they're not going to necessarily go for the big ticket item at the jewelry store or something else that's kind of
LVMH
obvious.
Bag or something.
Correct. So they might slowly ramp it up. And so what we're looking for are things that are out of pattern for a cardholder. So we maintain a profile of use for each and every cardholder. We understand what they're likely to do and what their expected next transaction is. And so when we see something off, we measure it and we calculate it, and they'll slowly ramp up. Now, with that said, if you wanted to get into fraud, the very best way to do that, girl, is...
I don't.
Okay.
No, but I'm just curious.
He was going to tell us how to fraud.
That's not what I meant. I'm just curious how they do it.
Yeah. That's what somebody who wanted to do fraud would say, Carol.
Yeah. So, but here's the thing.
So many words I want to say, but I'm on air.
So the more heinous sort of crime is actually called scams. And scam is where I trick you to sending me money. So I don't have to steal your information. I can social engineer you.
Do people really do that?
I get text every day.
But you don't bite.
Okay, well, today I got one that actually said Tim.
Okay.
Yeah, it didn't bite. But still, it's getting better.
Do people really?
It's a huge problem. So, for example, like they target the elderly. Those are a little less sophisticated, and they're very successful. And what's really damaging is sometimes they can empty out entire bank accounts, right? And so it's a really heinous sort of crime. So we all have to be on guard, and that's why we detect scams, and we have technology that tries to understand human behavior, use that machine learning, make predictions, and just give the banks, financial institutions, tools to protect consumers.
All right, so.
Go ahead.
30 seconds. Are scores going up or scores going down? I've got to ask you, you see the analytics. Are people stressed? It's a great indicator of the economy.
We're seeing drops in the number of transactions. So in terms of the number of sort of discretionary transactions that are occurring. So I think there is the stress, and we're seeing that in the payment data.
All right. We knew we'd get there. Thank you so much. Love the data. Did you want to say something?
No, go ahead.
You sure?
Yeah, that's it.
I am not a scammer. I'm not looking to do it. I'm just curious, how people think about it, because there's so many systems in place. Just wait till you're off air, Stenovec.
Oh, I am. I can't wait. Scott Zoldi is Chief Analytics Officer over at FICO, joining us here in the studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Some news today, McKinsey pledging to prioritize diversity across its workforce. This despite U.S. President Donald Trump ordering his government to push private firms to scrap DEI policies. Carol, McKinsey seems like it's in the minority right now, and I think that's why this is news.
Exactly.
Check out some recent headlines. You just go to Jeff Green's bio page, who covers diversity here at Bloomberg, and here's some of the stories that he's had a hand in. Shareholder advisor ISS, Institutional Shareholder Services, kills diversity criteria for boards. Booz Allen scraps DEI programs in reaction to Trump orders. Goldman scraps diversity rule for IPOs in latest DEI retreat. Accenture abandons diversity targets, citing Trump's orders.
Yeah, we definitely have seen a trend in terms of organizations, companies, institutions, really just, kind of rolling back their DEI efforts, or at least publicly saying that they are.
Aurora James is the founder of the 15% Pledge. It's the organization that works with companies, at least in its own words, to, quote, implement meaningful change and create greater equity for Black businesses, including designating 15% of their shelf space for Black-owned brands. We've spoken to her before. She's back with us from Los Angeles. Aurora, how are you?
I'm so well. How are you guys doing?
We're doing really well. I'm wondering your reaction to what companies are doing. I read some of the headlines right then. It seems like a real sea change from the conversation we would have been having with you about 4 years ago.
Yeah, I mean, it's really disappointing to see a lot of these major corporations do these, what I kind of like to think of as PR rollbacks. Target and Walmart, I don't think that they're necessarily, the places that we always think about as being that diverse. That being said, it's disappointing when we hear any major corporation want to roll back diversity, equity, and inclusion. I think the thing that I know to be true is that consumer sentiment and consumer values haven't changed over the past 4 years. We still know that people are more interested than ever in shopping with their values. And so I think every corporation that we partnered with at the 15% Pledge, whether it's Sephora or Nordstrom, are really proud to continue with these commitments.
How do we know that? What are the data that we have that say that customers actually care about this stuff?
Yeah, there's a lot of data, actually. You mentioned McKinsey earlier, and they did a lot of consumer studies a couple of years ago. And so I really urge people to look up that information, because I think there's a misconception that everyone that voted for Donald Trump doesn't believe that, differently abled people or women or diverse peoples shouldn't get a shot. And I think for me, I truly believe that everyone just deserves a chance at the American dream. You guys have all heard this saying before, that talent is distributed equally, but opportunity and access is not. I think DEI programs are just making sure that everyone gets a chance.
So I am curious, Aurora, do you think that companies are saying one thing and still maybe doing something different internally? I'm just curious if you've been able to do kind of a temperature check on things, because I think we're trying to figure it out. Is it just a case of publicly saying, okay, this is kind of what seems to be the mood, certainly out of the federal government, but we're going to still do this internally. What are you hearing? What are you seeing?
Yeah, I mean, know that they are, to be honest with you. We just had our big annual fundraiser that happened. It was our most successful one to date. We had a lot of major corporations in the room, including a lot of people who, were also represented at the inauguration. And I think at the end of the day, we know that we need to have diverse voices at a table so that we can do the best business, right? The consumer base is broad all across America, all across the world. If we only have a singular point of view, we're going to be missing the opportunity to reach billions of people around the world. So I think really smart leaders know that that's the reality of the situation. I think that there's a lot of people that are kind of, saying what they need to say in order to appease certain groups of people, especially if they have government contracts.
Well, I guess what I want to ask you is, the train has left the station, right? We've been talking about DEI efforts for a long, long time and have seen, companies, organizations put them into effect. You can take down websites, you can say you're not going to have official programs, but do you think that the momentum kind of continues, that I think organizations, leaders think about diversity because it is, McKinsey has said it's good for institutions, it's good for organizations, it's good for the financial bottom line.
Yeah, I mean, we've worked with McKinsey for a really long time, and I've always believed, in my very first day that I launched the pledge, I explained to people that I think not only is it the right thing to do, I think that it's really smart for business, and that's what we've been proving out. So to be honest with you guys, I think there's a lot of people that looked at DEI as a 2020 bandage and were never really committed to figuring it out, right? And I think that those who worked really hard to figure it out, like Sephora, have seen a lot of success and are unwilling to back down from that success. And I think that McKinsey is the exact same situation, right? So I think it's all about implementation, just like it is with any other system that happens within the corporate environment.
All right, we're going to leave it on that note. Aurora, thank you so much. Aurora James is the founder of the 15% Pledge, joining us from Los Angeles.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18, 19 minutes to go until we wrap up the trade on this Wednesday, February 12th. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Broker studio. You heard Charlie breaking down the trade here. It's been relatively quiet on the equity front. What's been interesting, certainly today, coming off that hot, quote unquote, hot inflation print, has been the move up that we've seen along the U.S. Treasury curve. Right now, that 10-year note with a yield of 4.63, 2-year note, shorter end 4.35. So interesting there. Let's see what Leo Kelly has to say. He's founder and CEO at Verdence Capital Advisors, joining us once again from Hunt Valley, Maryland. Leo, how are you?
I'm well, Carol. How are you?
Hanging in there. A lot coming at us, a lot coming at investors. One of the things I keep wondering is, for those who manage money for clients, do you kind of sit tight and wait for the dust to settle? Or if you've got, are you putting money actively to work?
Well, you always have money at work, first of all. I think there's this concept of money goes in or goes out because of any specific moment. Now, you do underweight and overweight based on valuation, based on macroeconomic expectations, et cetera. And so where we are at the moment, we're slightly overweight equity, but we are underweighting these, what I would consider highly valued growth names. And we're definitely underweight fixed income. And so holding more cash, really a lot of dry powder on the sidelines, ready to put to work. I do think a fair amount of volatility is inevitable here coming up in the next several months.
What's it going to take for you to use that dry powder? How much do you need to see stocks fall in order to say, okay, now is the moment to pounce?
Well, first of all, because that dry powder is coming from the fixed income markets, we could be more patient with it. We're fully invested in equity.
But does the dry powder go to fixed? Does it go to fixed income?
It could go to equity. If we get a pullback in equity, right, then naturally the allocations start to come down and we'll put money to work. I think if we take a step back and we look at where we are, you know this, we've said this over and over again on your show, people become overly optimistic about inflation coming down. We think this inflation story is a long story, and we've got a long way to go. So we're not really excited about the fixed income markets right now. We are starting to see some extraordinarily elevated valuations in the big tech names, the AI. I've said this before, it can go anywhere, but it sure is starting to feel like 2000. And what I think people have to remember is in 2000, 2001, the NASDAQ was falling precipitously, but the rest of the market actually you could make money in. And so we have broadened out our exposure. We put a lot of money to work internationally at the end of last year. That's worked out so far this year. So there's plenty of places to put money to work where valuations are much better than these hot stock market names.
You know, it's interesting. A couple of things. First of all, I feel like when we, kind of look for gainers and decliners every day, it's interesting to see it's not just your Mag 7. I mean, CVS, you've got Gilead, and some others. It's just interesting. You do see a broadening out. The thing, though, I want to seize upon is you putting money to work overseas. We had a lot of people, I feel like, at the end of last year saying, Europe, 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 look overseas, other opportunities. And you've actually seen, if you look at some of the European markets, a pretty strong start to the year, and perhaps better than even what we're seeing here in the U.S. market. Where are you putting money to work overseas?
Yeah, we are in Europe. Japan looks interesting as well, but Europe looks really interesting to us. I think it's really just a valuation play, right? Those companies are going to experience the same uplift from AI productivity, from the U.S. economy gaining strength, et cetera. But we're talking about, we started to touch around a 3 standard deviation valuation spread between the U.S. S&P 500 and the European main markets, driven by this massive valuation in the top handful of names in the S&P 500. When you start to get gaps that wide, historically, that works out very well if you're a long-term investor, if you put the money to work and let that play out.
Hey, what in terms of, Leo, what's coming from Washington? I mean, it's been an interesting couple of weeks in terms of what's going on out of Washington. And, we watch because the markets react, certainly off of, tariff, expectations of tariff, even talk of tariffs, or talk of tariffs, but delay in tariffs. What in terms of policies do you think ultimately become a reality and that will have to be what investors take into account and trade off of?
Yeah, the tariff conversation is actually a pretty interesting conversation because what we're hearing now is that the putting tariffs in is going to add to inflation. We have continue to be under the opinion that we continue to try to look for solutions to inflation from through areas that don't affect inflation, at least not in this market, right? Moving interest rates around really isn't the solution. Lowering energy prices, which is what Trump's saying is going to happen, isn't really going to be the solution. The supply of money is just dramatically too large. M2 grew at a stunning rate of 40% over a couple of years. And if you look at the correlation between inflation and money supply, you'll see a pretty accurate correlation. As inflation dropped last year, money supply had dropped. It was going down by 5%. And now we're starting to see inflation get hot. Well, guess what? M2 is up about 5%. So I think you have to separate the noise of the tariffs with the true impact. Now, in terms of the tariffs themselves, anybody who's followed Donald Trump for more than a day knows that he's a negotiator. And so his goal many times is to move the goalpost, right? If you're negotiating in the middle, well, then the way to get the middle move is move both goalposts. And these tariffs are, in many cases, his way to create a new negotiated middle. It's been effective so far. It was with Mexico and Canada. We'll see if this continues. And so I do think right now we're in that early stage of him trying to punch the goalpost into another direction. So I think we have to be patient and see what actual tariffs hit versus what are just negotiation tactics. I think it's still too early to make any dramatic assumptions, but we are keeping our eye on it. As a matter of fact, one of our analysts is specifically looking at each tariff threat and then as they come to fruition, what it means to our portfolios.
Hey, Leo, we only have about a minute left here, but we were watching Elon Musk in the Oval Office yesterday talking about Doge. Do you anticipate any impact from any success that he has cutting government spending at Doge?
I think he has the opportunity to. I think if you think about this is common sense. It's what everybody's wanted for a long time. It doesn't matter if you're a Democrat or a Republican. I think if we take a step back, cutting unnecessary spending makes a lot of sense. I do think they need more structure. I do think that they have to come up with a more, let's call it stable structural way to go about this. And I do think they will do that. So I am hopeful that they are going to cut spending. And going back to that inflation issue, right? The supply of money is impacted both by the Fed and by federal spending. So reducing federal spending and getting the Fed to calm down a little bit with money supply growth might actually be the solution to inflation, not just cutting a short-term rate by 50 basis points.
As always, a great take on our environment. Leo, thank you so much. Leo Kelly, he is founder and chief executive officer of Verdence Capital Advisors.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.